Well, I think it's going to be rather a big challenge for the ECB president. I think we need to separate two things. First of all, the flow of data on the monthly HICP releases, they're rather volatile, and so the ECB, I would expect, would say that some of the factors which drove headline and core inflation sharply down in August will partly unwind in the subsequent months. There's a lot of seasonal factors which are making the data volatile. But beyond that short-term noise, the key problem they face is based on their projections back in June. They were telling us that the underlying rate of inflation, excluding energy and food, would be just 0.7% in 2021, 0.9% in 2022, even on the basis of quite a positive scenario for the economy after the initial COVID-19 shock. We now have the exchange rate well above what they were assuming when they put those projections together. For example, if we assume, say, euro-dollar stays around 120 for the remainder of this year and at the same level in 2021, we're talking about a 5% and 10% difference, respectively, compared to what they assumed in their June projections, and using their own rules of thumb for the impact of that on inflation. We're looking at least a quarter percentage point off the inflation rate over that time horizon, pushing it even lower. So it's very difficult for the ECB to avoid delivering additional policy accommodation in that regard. And really, I think it's just a matter of time. It'll be more likely when they get to the December meeting, they'll give us forecasts for 2023 for the first time. They'll be persistently low, and that will likely be the trigger to do more.
So in terms of the further stimulus that you envisage, most analysts are looking at this meeting as an opportunity for the ECB to essentially hint at further stimulus at that December meeting. What's the scale of the stimulus expansion you are expecting later in the year in terms of the amount by which we could see the PEPP expanded and the time frame?
Yeah, well, I think it's very clear that the ECB will do more. I mean, they have a very explicit bias to ease. It's been there for a long time, and that will be reinforced today. I think the question is, what policy tool do they favour? It's been the PEPP up until this point, probably remains that way. We think an expansion of about 500 billion announced in December is a reasonable expectation. Could be a little bit either side of that. But that's our baseline. The question for today is, do they put more emphasis on the possibility of the deposit facility rate coming down again? Because the exchange rate is much higher than they've been assuming. And I think there's a good chance we'll see a hint of some kind today. We've seen the ECB in the past talk about unwelcome currency appreciation and excessive volatility. One of the issues today is, does it just make it to the press conference, i.e. something that the president says, or is it in the introductory statement? And that would be much more impactful, because that would mean that there is broad support across the Governing Council for a change of stance. I think that's going to be a key indicator for the markets to look at this afternoon. But our feeling is the PEPP is still a tool of choice, still a preferred policy instrument, but it's very likely that they're going to say something about the exchange rate, and in turn the market may reappraise the view that the DFR is at the lower bound already.